Debt is a word that makes most people uncomfortable. For the average household, debt means credit card balances, car payments, student loans, and financial stress. It means owing money that must be paid back, often with interest that keeps growing every month. Millions of people are taught from childhood to avoid debt, fear debt, and get rid of debt as fast as possible. But for the wealthy, the investors, the business owners, the financial strategists, debt means something entirely different. It is not a burden. It is a tool. It is leverage. It is a way to multiply opportunities, scale wealth, and grow faster than would ever be possible using only their own savings. And understanding how the rich use debt is one of the biggest differences between those who struggle and those who build lasting financial freedom. To understand this mindset, you need to look at how the financial world treats different kinds of debt. When the average person borrows money, they typically borrow to buy something that loses value. A car, consumer goods, lifestyle upgrades, or sometimes even a degree that doesn't generate income. These are liabilities, things that drain money instead of producing it. So the debt becomes a weight that limits financial mobility. But when wealthy people borrow money, they almost always borrow to purchase something that makes more money. Their debt creates cash flow. Their loans fuel investments. Their interest payments are simply the cost of accessing more capital than they currently have. To them, debt is not a burden. It is a bridge that leads to bigger opportunities and bigger returns. Consider real estate, one of the most powerful examples. A wealthy investor rarely buys a property with their own cash. Instead, they use financing, sometimes 70%, 80%, even 90% borrowed money, to acquire an asset that someone else will help pay for the tenants cover the mortgage. The property appreciates over time, the rental income becomes profit, and the investor controls a high-value asset while using very little of their own money. This ability to use borrowed funds to multiply buying power is called leverage, and it is one of the core principles behind how the wealthy expand their portfolios. If they have $1 million in cash, they don't buy a $1 million property. They buy 5 or 10 properties worth far more. Debt becomes a multiplier of wealth. But what makes this strategy even more powerful is the role of taxes. When average people earn money from a job, it is taxed before it ever reaches their hands. When they use debt, they pay interest after taxes, which reduces their take-home income. But when wealthy individuals use debt, the system works in their favor. In many countries, interest paid on investment loans can be deducted from taxes. That means the cost of borrowing becomes cheaper, and sometimes the government effectively subsidizes the investment. Even more surprising is that debt itself is not taxed. If a wealthy person takes out a $5 million loan against their real estate portfolio, they can spend that money however they like, buying more assets, expanding businesses, or even covering personal expenses. And they don't pay taxes on that borrowed amount. Meanwhile, their investments continue generating income. This strategy allows them to access enormous amounts of capital without triggering taxable events. It is one of the quiet, often hidden advantages that separates wealthy financial behavior from ordinary financial behavior. Another major reason the rich embrace debt is because it protects their cash. Instead of locking up their money in a single investment, they keep their liquidity available for new opportunities. Markets move fast. Deals appear and disappear in days. Having cash ready allows investors to react. Using debt means they never drain their reserves. They let banks take the risk on funding, while they maintain flexibility. Liquidity is a form of power, and wealthy individuals guard it carefully. This same mindset applies in business. When a company wants to expand, open a new location, acquire a competitor, or build new products, it rarely uses its own savings. It borrows. Large corporations take on billions in debt not because they are struggling, but because borrowing allows them to grow faster than relying on internal cash flow. Debt accelerates expansion, and the returns from that expansion outweigh the interest costs. It's the same principle individuals use in real estate, just on a much larger scale. What's even more interesting is how the wealthy use debt to manage risk. To most people, debt feels risky. To the rich, debt reduces risk because it spreads their exposure across multiple assets. Instead of putting all their money into one investment, they borrow to diversify. One asset might slow down, one market might fall, but because they're involved in many opportunities at once, their losses are softened and their gains are amplified. This diversification is only possible through leverage, and it creates a system where wealth grows steadily over time. A key advantage the wealthy have is access to good debt at far lower interest rates. When the average person borrows money, they often pay the highest rates. Credit cards at 20% or more, personal loans at 10% or higher. But wealthy individuals and businesses access money at 3%, 5%, or 7%, sometimes even less. This difference in interest rate transforms debt from a burden into a profitable tool. With low-cost capital, they can invest in assets that earn far more than the cost of borrowing. If their returns are 10% and their loan costs 5%, they profit from the spread. This is how financial systems are designed. The more wealth and assets you have, the cheaper money becomes. And the cheaper money becomes, the easier it is to grow that wealth even further. Perhaps one of the most misunderstood strategies of the rich is how they use debt to pass on wealth. When wealthy families want to transfer assets to the next generation without triggering massive taxes, they don't sell. Selling would create taxable gains and reduce the overall wealth. Instead, they borrow against their assets. The loan gives them the cash they need for lifestyle or investments, and the assets remain untouched and continue to grow in value. When they pass away, estate planning structures, such as trusts, manage the assets in ways that minimize taxes. The debt gets paid off, the investments remain, and the family keeps its wealth. This cycle keeps repeating and ensures that wealth moves forward, not backward. It may seem unfair, but the reason the wealthy use debt so effectively is because they understand something fundamental. Money is not just something you earn, it is something you control, something you allocate, something you leverage. Most people work for money. The wealthy make money work for them, and debt is one of the central mechanisms that makes this possible. They see debt not as a danger, but as a tool that, when used responsibly, opens the door to exponential growth. The irony is that the same financial tools available to the wealthy are also available to everyone else. But without financial education, they appear risky, complicated, or inaccessible. Schools don't teach leverage. Most households don't discuss tax-efficient investing. And as a result, many people spend their lives avoiding debt entirely, never realizing that the very thing they fear is the same tool the wealthy use to accelerate their success. The truth is that debt is neither good nor bad. It is neutral. It is simply a tool. In the hands of someone who understands how to use it, it becomes a powerful engine for growth. In the hands of someone unprepared, it becomes a trap. The difference comes down to knowledge, strategy, and discipline. And that is the real lesson behind how the rich use debt to get richer. If you found this breakdown informative and want more deep dives into the strategies that shape wealth and financial power, make sure you subscribe. Your support helps bring more valuable content to the channel and keeps these insights coming.